if you're an educated long-term investor, ETFs are the best, right? I mean, if you go anywhere on the internet, go on YouTube with all the experts, go to Dave Ramsey, go to your bookstore, what do they tell us? That the smartest, the best, the most prolific thing we can do is to buy something like this on our screen, the SPY, buy the SPY, hold it, suck it up through the bad times, and magically, 100 years from now, you end up rich. It's quite a great deal, right? I'm Scott Welsh, and we're going to talk about ETFs in this video. I will talk some numbers. They're meant to educate you and inform you, but they are not from actual trading accounts. Now, why talk about ETFs? Well, why do the experts talk about ETFs? It's because, number one, first and foremost, the stock market is efficient. Yay! We little people, all the dumb people of the world, try to pick stocks. Oh, they're so silly. They try to pick stocks, but it's pointless. Why? Because everything that needs to be known about a stock is immediately priced in. That's the information age we live in. There is no advantage. Everything is properly priced. Even if you see a stock that trades in a 52-week range from $5 to $500, meaning that that company has gone from worth $10 to $1 billion in a single 52-week period, that's normal. That's absolutely exactly the way it should. Companies and your house and your car fluctuate wildly, and it's perfect, right? Because information is efficient, but specifically the stock market is efficient. So don't even try to trade, people, all right? Well, if that's the case, specifically then, why are ETFs like the SPY, the S&P 500 ETF, why are they the best? Well, they're the best because a benevolent company has put together in one instrument, a one-size-fits-all, like the SPY, all the companies in the S&P 500. They combined them all. They mashed them all together. And if you just trade the SPY, then you get the average, I guess, for lack of a better word, of how all those companies' stocks are doing all in one place. So if the S&P does well, the SPY goes up. And if the S&P 500 companies do poorly, it goes down, right? For only a small fee, you can get all of this wrapped into one, right? It's pretty cool, even though they charge fees, but it's pretty cool, right? But here's why else they're the best. They're diversified. Instead of trading 500 different companies, something like the SPY or the VOO, the VOO, those can do it all for us, right? So if you're looking for early retirement, like the wildly popular FIRE movement, Financial Independence Retire Early, early retirement, they will tell you, they'll yell at you, they'll slap you in your face until you agree that all we have to do is save 80% of our income, eat warm rocks for dinner, and trade the SPY. Put all of our pennies into an ETF like the SPY. Why? Because the market can't be beat, and because it's diversified, right? Well, I guess the question is, has it worked? I've never really seen it work with my own eyes. I mean, I have family members that supposedly invested in the stock market over time. I mean, I know it works. I'm not doubting that it works, but it seems like kind of a roll of the dice to put all of our money into just one ETF, right? Specifically, a stock ETF. Because someone smart once told me that 75% of a stock's movement is the market itself. Meaning, stocks tend to all go together. You very rarely see the market tank, and then here are a bunch of stocks doing great. They exist, but it's not very many, right? So if they're all doing the same thing, how am I diversified, right? It seems like a roll of the dice. Oh, but here's another roll of the dice if you decide to put your entire life savings and all of your future into a quote-unquote diversified instrument like the SPY. Here's the year 2000. Oh, that's not great. Hey, we're back. 2002, the dot-com crash is over. And then the great financial crisis, the housing crisis. Now we're back as low as we were in the early 2000s. Whoa, wait, this is 2009. This is 2002, 2001. How much money did I make from here to here? Zero. How many years was that? 1, 2, 3, 4, 5. Right? Several. That's our investment. You started 2002-ish, and in 2009 you've got nothing. Okay? Then it comes back up and dips again, right? In 2000, between 2010 and 2012. So for over a decade, you made nothing. Your life savings, your FIRE movement went nowhere. Interesting, huh? Now, changing the subject, kind of. What is a Forex currency pair? Maybe you've heard of it. Sounds kind of complicated. Well, I'll tell you. A currency pair, Forex, is foreign exchange. Forex, foreign exchange. It's the interest rate that companies and central banks charge on money, right? Well, what goes into that interest rate? And if you've been watching the news or Yahoo Finance or wherever you get your information, hopefully from a good source, we're talking about is interest rates, right? So what goes into it? Well, worldwide political policies, right? What's the global economy doing? What's the GDP growth of our country? Is it going up? Is it going down? That's different for every company. What are the central bank in my company? What is it doing? What's the central bank policies? What are their decisions? Oh, and then there's inflation. If inflation goes up, what does the Fed have to do in our country, in the US? Well, they have to raise rates to get rid of inflation. But that will put us in a recession. But we're not in a recession. Yes, we are. No, we're not, right? We have multinational earnings. Companies may be based in the US, but may have trade in other countries. Well, the difference between the money made in England and the money made to the US has got to get transferred back, and then you have to convert that. Getting the picture, there's a lot going on. Oh, but there's more. Consumer sentiment, right? Interest rates goes up. What happens to consumer sentiment? It gets worse, right? Well, are we in a recession? We're not, right? Unemployment in the US just got cured from the pandemic, but interest rates are high. Inflation is high. Consumer sentiment is down. Very complex. And of course, imports, exports, which we kind of mentioned. All of that in various different forms goes into a country's interest rate. Now, in Forex, multiply that by 2, right? It's not just all of it going into, say, the US. It's going into the relationship of the US versus something else. And there are Forex pairs that take one country's rates, compare them to another's rates, and there's all different regions and countries and so forth, okay? So now we're taking all of that complexity of one country and then comparing it to all the complexity of another country. Wow, that's a lot going on. So for example, the pound-yen currency pair, Great British Pound, Japanese yen currency pair, takes all of that stuff into consideration. And then it takes into consideration how those two countries' policies relate to each other. So in Japan versus Great Britain, that's a very disparate part of the world, very different economies, very different cultures. And now we're looking at a pair, a relationship between those two. That takes a lot into account, does it not? So we could choose that for diversification, which covers so much ground. Or we could just take 500 companies' earnings, which is basically what the S&P is, right? If the earnings in the S&P goes up, what happens to the SPY? What happens to those company stocks? They go up. And didn't we mention that they all kind of go together anyway, right? Even though you have 500, they kind of just all move the same. Interesting, right? So let me ask you this. If you think about it, isn't one Forex pair more diversified than the SPY? I mean, isn't it a lot more diversified, I make the argument? And if it is, can we just trade one Forex pair instead of the SPY? If we're looking for diversification, the answer seems to be yes, right? Now, I'm looking around. I don't want anyone to hear this. What if it's more diversified and it makes more money? Dun, 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 right? That's the sound effects. We've got a big budget on this YouTube channel, right? Assuming any of that is true, here's the system. Right now, I chose for this one, this is the Master Trend Robot, in case you're wondering. It's on the daily chart. I trade things, and I have traded things that are not daily, but daily and weekly systems are very robust as a rule. Not always, of course, but as a rule. Why? Because daily charts don't have the noise, don't have little minor news breakouts or little minor blips. Daily systems tend to hold up over time, which is why all the experts, the retire early experts, say you have to give it time. Well, a daily chart holds up over time, which allows you to stay in over time. At least that's how the thinking goes. Well, here's a system for you for free. Wow, free, what a deal. This is the Bollinger Band and RSI daily pound yen. And I've talked about this in my newsletter, and I've talked about it in various other times, right? Maybe even, no, not on the YouTube channel though. Here's the log entry, ready. When price closes above a Bollinger Band, trademark, when price closes above a band, and that band is the standard it is the typical default length of 20 and a standard deviation of 1.4, which is different. I optimized that. I don't want 2 is typical. I went a little below that. Now, I've been looking at Bollinger Band lengths for many, many, many years. And in counter trend systems, I like it well over 2. And in trend following systems, I tend to like 2 and under. That's a little tip for you if you care. Now, if price closes above the band, guess what that means? A long trend might be beginning. If it closes below a band, then a short trend might be beginning. We're using an expansion of volatility to signal, a trend might be starting. Okay? But that's not enough signals for us. What if it's inside the band, but the RSI closes down, or closes, up, it's overbought, closes up into overbought. Length is 5 and overbought is 70. Okay? So if RSI closes above 70, but the Bollinger Band is not above the band, the upper band, we still take it. It's an or. Okay? Or. We're looking for either one of those situations. Why not choose just one? Because we want more trades. We want more chances to get into a potential trend. That's why. And the Master Trend Robot allows me to do that. I can put it in and even use a third indicator if I wanted to, but this one only has 2. So if we're going long, again, price closes above a band or RSI closes into overbought. Closes. Got it? Short entry is the opposite. Price closes below a band or when RSI is into oversold. Same settings. Okay? Long profit is 400 pips. It's a daily chart. Let's go for a big move. If you don't know Forex, that's a large move. Most targets are between 50 and 100 in Forex. This is obviously a big move because this trends. The short profit is different. Oh, that you can't do that. Well, I did it. And the short side of the market and the long side of the market are not the same, so I don't treat them the same. So that's why I did that. The stop is 190 pips to give it plenty of movement, but we're not going to do this forever. If it doesn't work in about, 4 weeks? There's more than that, right? There's Monday through Friday plus a little bit of Sunday in Forex. Let's just call it 5. So it's about a month. If nothing's happened in a month, then we're in a dull period and we're done with this trade. That's it. We're not going past 21 bars. And if we do get 150 pips into profit, we will move to break even. The robot does this automatically. Okay? So we're on a daily chart with our pound yen ETF, quote unquote. It's not really an ETF. It's just a currency pair, but I'm pretending it's an ETF. Got it? And we're trying to get involved with trends because trends will always occur. Are you with me? Okay. This is 2022 using this system. Okay. It's up on a $20,000 hypothetical. Remember the disclaimer. $20,000 hypothetical account. If you took that amount of profit and divided it by $20,000, you get 15% profit as I wrote this and made this video, which is early August 2022. Let's see, what's the S&P doing this year? It's down, right? It's been down 20%. Now it's down 13%-ish. That's quite a change. right? You could be down or nicely up. This is this ETF. Wait a second. This ETF is up and the SPY ETF is down? Okay, just making sure. Now let's go back to 2007. Here is our quote-unquote pound yen ETF since 2007, which of course incorporates the financial crisis of 2008. Here is the equity curve. Great. Levels off. Great. Levels off. And now it's kind of just going sideways a little bit, but doing okay. All right. That's the long-term chart. That's 471% on a hypothetical $20,000 account. And the S&P has 168. 471 versus 168. Now, if you reinvested your dividends, as paltry as they are for the SPY, it would be a little over 200%. So in best case scenario, it'd be double, more than double. In the worst case scenario, if you took your dividends out, our ETF would destroy it. Okay? And as I used in the last video, because I just like this slide, whoa! This ETF, potentially more diversified, and potentially makes a whole bunch more money. So is this scary though? Right? Here is some stranger using PowerPoint. Who uses PowerPoint anymore? Some stranger on the internet making YouTube videos telling you about an ETF that doesn't really exist, right? And is telling you that it makes way more money and is telling you it's more diversified. It's weird, right? It's scary. Who would want to put their long-term FIRE movement into an ETF that's not really an ETF? Plus, it's Forex, which is scary and weird, right? But if you really think about it, why is this more scary than SPY? Why is this more scary when we just saw a slide where SPY can go sideways for 12, 13 years and do nothing? And there are other examples of the US stock market that can go nowhere for 20 years. There's a slide I've shown many times back in the 1800s where the stock market did nothing for 80 years, right? So why is this ETF, which trades the relationship of currency rates between two countries, why is that more scary than the S&P that may or may not go anywhere, right? Furthermore, most of these ETFs, because they're great business for the people who create them, haven't been around that long, right? There are some ETFs that are resoundingly loved on YouTube that have been around since like 2019, right? Especially the dividend style ones, okay? The pound yen fake ETF has been around since 2003. We have solid data from 2003 to 2022. That's a lot of data and is more than most ETFs. So we have more data. We have the logic behind it. We have better performance. It's interesting, right? It can really make you think. And when I told this guy, this is his reaction, right? It really made him think too, okay? Now, if you're looking for more thought-provoking, so thought-provoking. If you're looking for more stuff like this, of course, look around. I've made a lot of videos over the years. And if you go in the education playlist, for example, there are a lot of free systems. And now we're going to finish with some quick speed round. This is where you can start signing off if you are done listening to the video. It was created by the Master Trend Robot, and of course, that's for sale. You can trade it manually. I've given you everything you need, but if you don't want to trade it manually, you can buy it if you want. That's my website, scottwelsh.com. Wrote a book last fall, about a year ago. It sold actually pretty well, but there are free trading systems in there that are actually doing okay. And if you want to go for other, or look around for other trend following strategies, go to scottwelshstrategies.com and go to the performance page. You can see this is updated in early August. The SPY is down 13%, and I give you a bunch of systems plus the link to the YouTube videos so you can watch them. Right? The results, these particular results, I'm going to be tracking them far into the future, have been doing quite well in 2022. Okay? So think about your ETFs and think about trading long-term with a fake pound yen ETF. Something to think about. I'll be back next month with another video. Bye for now.